You've been stopped right before the move. You've bought the breakout and watched it collapse. That's not bad luck. That's a liquidity trap, and it was engineered. My name is Pablo, and this is the Research Desk, where every claim is cited, every strategy includes its failure conditions, and there's zero hype. If you're new here, welcome. If you've been here before, let's get into it. Today, 10 specific things you need to know to stop getting caught. We're going to cover it in 3 buckets: how the trap is built, how to see it forming in real time, and how to stay out of it. 10 minutes, let's go. Point 1. A liquidity trap isn't random price action. Here's the precise definition. It's a price move that triggers a cluster of resting orders, stops, breakout entries, and then it reverses. The traders who acted on that move are now stranded on the wrong side. You may have heard it called a stop hunt, a liquidity grab, a false breakout, a bull trap, or a bear trap. Same mechanic, different names. Here's what makes it different from just a bad trade. It's predictable, not every time, but consistently enough to trade around, because the orders don't sit randomly, and neither does the move into them. Price is pushed into a zone where orders sit dense. Those orders trigger, and then price reverses, leaving the traders who reacted stranded. That's the mechanic. Everything else builds from this. Point 2. Large orders need liquidity to fail. That's not a conspiracy, that's market structure. Picture this: an institutional participant needs to build a large long position. They need sellers to fill it. Where are the sellers? Sitting as stop orders just below the level everyone's watching. So price gets pushed into that zone. The stops trigger, forced selling hits the tape, the institution absorbs it, and then price reverses. Your stop wasn't bad placement. It was in the exact spot every textbook and every beginner puts it. That's precisely the problem. The most crowded stop location is the most attractive target. This isn't theory, it's the basic mechanics of how large orders get filled in a market with limited liquidity. Point 3. Liquidity doesn't pool randomly. It has a map. 4 specific locations, just past support and resistance, above swing highs, below swing lows, and at round numbers. The round number rule deserves its own moment. $100, $500, $20,000 on an index. Retail traders cluster stops at round numbers because they're easy to remember. That makes them magnets. Here's the upgrade. When a major technical level and a round number align, say support sitting at $50, treat it as a high probability trap zone, not a guaranteed trap. A zone that demands extra room in your stop placement and extra confirmation before you act. These 4 locations are the liquidity map. Know them, they don't change. Point 4. Real breakouts need real buyers. Traps don't. When price breaks through a level on a quiet, unconvincing volume, that's your first tell. Volume is the market's conviction meter. Low conviction means the move isn't real. Here's what to watch. Compare break volume to the volume that formed the level. If the level was built on heavy volume and the break comes on significantly less, treat it as a warning, not a signal. A useful threshold. Any break where volume runs less than 50% of the average at that level puts you on alert. That number is worth anchoring. Weak volume alone isn't the signal, but it's the first flag on the checklist. Point 5. Watch how long price spends on the other side. A real break spends time past the level. It closes there, it consolidates. Buyers defend the new level, acceptance happens. A trap doesn't. Price pockets past the level and snaps back within a candle or two. No acceptance, no consolidation, just a stab and a reversal. The fast reclaim is one of the cleanest tells we have. If price can't hold past the level, if it's back inside within 2 candles, the break wasn't real. Time is the tell. Real breaks take time. Traps don't have it. Point 6. The candle tells the whole story. A trap leaves a long shadow, a wick, past the level, but the candle body closes back inside. Price went there, triggered the orders, and rejected, all in one candle. A real break closes past the level. The body is beyond the line, not just the wick. That single distinction, wick past the level versus close past the level, will keep you out of more bad trades than almost anything else on this list. One candle, two completely different outcomes. Point 7. Here's one most beginners miss. The cleaner a level is, the more textbook, the more widely watched, the more obvious, the more orders sit around it, which makes it the most attractive target. That sounds backwards. If everyone sees the level, shouldn't it hold? Not necessarily. If everyone sees it, everyone's stop is in the same place. That's a dense cluster. Dense clusters are targets. The lesson isn't to avoid obvious levels, it's to treat them with more skepticism and demand more confirmation before you trade them. The more obvious the level, the more you should wait. All right, 3 tails down. Before we get into the defense, if this is sharpening your edge today, hit that subscribe and like button. Research Desk publishes every week for free. On to point 8. The most common mistake is placing your stop at the obvious spot. Just below support, just above resistance. Exactly where the textbook says to put it. That's precisely where the sweep is designed to reach. You need to be beyond that. Here's how. Add a buffer past the obvious zone, enough to absorb the sweep without triggering, not a penny below support, meaningfully further out, past the wick range of the level. Now, here's the adjustments most traders miss. If hiding your stop means risking more per share, size the position smaller to keep your total dollar risk flat. The math stays identical. Your position just survives the sweep. Same risk, different placement, different outcome. Point 9. Don't trade the poke, trade the confirmation. Simple in theory, hard in practice, because the poke looks exactly like a real break in real time. The rule is this: a breakout isn't a breakout until a candle closes past the level. Not a spike, not a wick, a close. If you wait for the close, you will miss the first wave of some real breakouts. Accept that trade-off. What you gain is staying out of traps, which form on pokes, not closes. The cost of waiting is slippage. The cost of not waiting is getting stranded on the wrong side with your stop already triggered. Wait for the candle to close past the level every time. Point 10. This is the one that flips the script. Once you recognize a trap, it doesn't just protect you, it gives you a trade. Here's how it works. Price sweeps below support, volume is weak. The candle snaps back above the level within 2 candles. That's the reclaim. That's your entry signal. The mechanics support the trade. The stops are cleared. The weak hands are flushed. The buyers who absorbed the selling are now holding. The path of least resistance is up. Wait for the reclaim candle to form. Confirm with volume. Enter in the direction of the reversal. Place your stop below the sweep low. Now clearly defined. The trap becomes a trade. That's the full difference. 10 points, 3 buckets, 1 discipline. Demand confirmation before you commit. Not every wick is a trap. Not every breakout is a lie. The goal isn't to distrust all price action, is to stop acting on the first move and start acting on the confirmation. The full liquidity trap study is linked below. The annotated charts, the 4 defenses, and the work example at, as of today, $49.79 support with bookmarking. If this gave you an edge today, smash that like and subscribe button for weekly market research. It's free every week. Tell me in the comments. I definitely want to know which of these 10 tells have you been ignoring. Drop it below. Until next time, trade smart, stay curious, and keep your emotions out of your portfolio. Thanks for watching. See you next time.